Murphy's Law states anything that can go wrong will go wrong. And in the upcoming week, there certainly is enough firepower to move the markets and put you on the wrong side of the trade. We have the FOMC, the quarterly refunding announcement. 5 of the Magnificent 7 are reporting earnings this week, and we also have employment data. And while there are no guarantees in life, one thing I can guarantee you is turbulence. So fasten your seatbelts and get ready for the ride as we build a game plan for the next week ahead. Guys, welcome to a special weekend edition of the show. We keep these ones more relaxed, more chill. My name is Chase. And guys, we talk about stocks and the financial markets and give you the most concise and informative daily recap on what's going on around the world, specifically America. So if you like these videos, please subscribe, hit the like button and that notification bell. Let's get into it. Guys, welcome to the weekend show. This is the weekly heat map for the entire S&P 500. The best performing sector was energy for the week, but in a very close second was actually a subsector of comm services right here, telecom services and entertainment. Very, very strong week as a whole for them, as well as Google and Meta putting up a very decent week. Microsoft outperformed tech as a whole, same with Nvidia in semiconductors. But after Intel's earnings, semiconductors may come under pressure in the next few trading days, even maybe a couple of weeks. Financials put up a very good week as well. But all in all, it was mixed across the board unless you just truly beat on earnings like American Express, like Airbnb. Now, guys, the weekend poll is still going. It's not finished. 149 votes, and it seems people are more on the bear side. 58% of you are bearish, 42% of you are bullish, and we'll see what the results are in Monday's video. So I got some more stats here for you guys. This is a January to February barometer, and pretty much what it is, the S&P 500 performance from January 27th to February 15th, when the trailing quarter, October 27th to January 27th, is greater than 5%. So we put up a trailing quarter of 18.78%. So from October to January, a very, very strong quarter. And in fact, October 27th is actually where we made the low and then rallied to the highs where we are right now. And this is what we can expect. Average return from January 27th to February 15th. So pretty much 2 weeks of trade, 2.3%, 21 up years, 5 down years, 1% moves or more, 17, 3% moves or more, 9, 5% moves or more, 5 from 0 in that time period. So stats are on the side of the bulls for the market to go higher because of what we've done between October and January. And momentum brings momentum. And this actually aligns perfectly with my seasonal performance for February. Now, based on the barometer I just showed you, we are expecting higher price action in the S&P 500. And you can see here that based on February seasonal performance, normally we actually do move higher into February. It's normally around the 11th, 12th, and 10th trading day of February. That's when we do see sell side come into the tape, compounded with the fact that the window of weakness is coming to an end on Thursday or Friday. We could definitely see this price action occur in the S&P 500. And it's very true to form. Momentum brings momentum, and there's a lot of confluence happening in the S&P 500 here with the seasonal performance for February as well as the January to February barometer. Now, looking at data, now we have some very big data prints this week, starting off on the 30th with the JOLTS report. We also have consumer confidence. On the 31st, we have employment data ADP. It's businesses 20 to 50 employees in size. Then the big one on the 31st, the FOMC rate decision, and it's not on yet, but we also have the QRA, the quarterly refunding announcement. On Friday, the 1st, we have initial jobless claims, non-farm payrolls, global PMI manufacturing, construction spending, ISM manufacturing, average hourly earnings, consumer sentiment. So a lot of data on Friday and the 31st. So a lot of data on Wednesday, a lot of data Friday. Now let's actually talk about what we can expect from the Fed on the FOMC. Based on Fed fund rate futures, you can see right here, it's going to be a hold. The current federal funds rate is sitting at 5.35%, 96.9% chance we hold. There is still a very slight probability, 3.1%, that we do get a cut. Highly unlikely. And the reason why why the Fed are reluctant to cut is due to this right here. So this blue line is CPI starting in January 1971. This is CPI starting in December 2018, right? And pretty much the Fed is very, very afraid of CPI re-accelerating like it did in the 70s. The Fed around 1977 cut rates a little too early, and then inflation re-accelerated to as high as about 14.9%. It did come down aggressively after some aggressive rate hikes, and we saw interest rates about 17%. Absolutely crazy. And this is what the Fed is afraid of. And we're kind of tracking it like for like, although the nominal numbers are less than what it was in the 70s. And this is why the Fed is extremely reluctant to come out with a insanely dovish tone, and why they want to be data dependent so they don't get a resurgence of this inflation. Because if the Fed nails a soft landing, Jerome Powell goes down in the history books. But if inflation reaccelerates, not a good look for him, not a good look for his reputation. And part of the reason why the yield curve is inverted right now is because of the Fed's reluctancy to cut rates. Because of that, the yield curve is inverted right now, especially the 2s and 10s. Now, this line right here is uninversion, and the returns we can expect during an inverted yield curve and after uninversion. And normally we can see both the average returns and the median returns when the yield curve is inverted is not that great. Average returns 1 month on 1.97%, 6 months on 2.15%, 12 months on 7.56%. So very muted returns in comparison to the index. We could also see here that returns while the yield curve is inverted, 12 months, so 0 to 12 months is 2%, 0 to 6 months negative 0.45%. Within 1 month, you get about a 1% return. And the reason why the averages are less than the benchmark has to do with the fact that when the yield curve is inverted, it's generally a sign that there's something wrong in the economy, the credit markets, the stock markets. Something is not right, and that's why the yield curve is inverted. Now you can see right here, based on these 3 stars, when the US economy is already in a recession after uninversion, the returns we normally get are quite spectacular after the Fed cuts rates in all instances. And that's because normally a lot of the drawdown has already happened. Now, do I think we're going to enter a recession? The answer is probably not. I mean, GDP growth figures came in at 3%, and a lot of it was just consumer spending, government spending. And as long as we keep getting GDP numbers like this, I highly, highly doubt we're going to enter a recession. And simply put, we're not going to enter recession. Growth actually accelerated in this quarter. Now, we got some news from the BofA trade desk. Very interesting stuff. Let's go ahead and read it. So their weekly viewpoint: GDP cooled, but not nearly as much as we expected. The economy continues to defy expectations. Progress on inflation continues despite the resiliency of the activity data. They expected headline core PCE and inflation to rise by 0.5% month over month and 1.7% respectively. And we know what the numbers are with PCE when they came through. And they expect the Fed to shift to a neutral rate guidance next week. We expect the Fed to stay on hold in January FOMC meeting and change its policy rate guidance in the post-meeting statement to a more neutral language instead of hawkish or dovish. This would be a de facto easing bias, since most of the Fed members have indicated the hiking cycle is likely over. We forecast non-farm payrolls rise by 175% in January, slightly below the 193K average gain over the past 6 months. Job growth should again be narrowly driven by the public and high-touch services sector. Meanwhile, the unemployment rate is likely to remain at 3.7%. The participation rate should recover to 62.7%. This report should also include annual benchmarks to the payroll numbers, and updated population estimates will be incorporated into the household survey estimates. So that's what both would think right there. Very, very interesting. And the economy continues to remain resilient. So we do get a ton of employment data this week. JOLTS, non-farm payrolls, ADP, average hourly earnings. The jobs market has been secularly tight for all of 2023, and it has kept the economy roaring. It has kept the consumer strong. But January is notorious for layoffs, and we should see slightly weaker jobs data coming in this month. Now, this is completely normal in comparison to seasonality. The Christmas period tends to make January job data weaker than usual. Layoffs and discharges tend to be higher than average, and it has to do with businesses hiring a lot in November and December for the Christmas period, but expect jobs data to be slightly weaker than usual on Friday and Thursday when those data points do release. Now, looking at QRA, before the Fed's decision, all eyes will be on the big Treasury debt announcement by Janet Yellen. It's coming on Wednesday. Now, we do know, I've shown you guys this chart for a while. QRA is a market mover both to the downside and the upside, depending if the issuance comes in as the market expects or below market's expectations. Now, let's actually talk about the consumer. Now, PCE, personal consumption expenditure, month over month came in at 0.5% for this last print. And then the year-over-year change, core PCE, excluding food and energy, which tends to be quite volatile, came in at about the 3% mark around it. The consumer remains strong in the US, but we're also seeing signs the consumer is strong in Europe. This guy right here, I don't know how to say his name, I think it's Bernard. He is the owner of the behemoth luxury brand LVMH, and they reported their earnings on Friday, and it was a beat. 13% above expectations of 9%, $86.153 billion in revenue, 25% from the United States, by the way, 31% from Asia. Very, very good earnings. The market seemed to like it because the stock was up 12.81% during the Friday session. It opened at about 435 and just absolutely rallied on the news of better profits. And it probably means the consumer is hanging in there, not just in the US, but around the globe. And really, maybe everything is starting to bottom out after the COVID situation, all of the money printing, and just how decimated the economy was. We also have earnings in the upcoming week, a big week of earnings. Some notable names: SoFi before the open on Monday, Supermicro after the close on Monday. Now, they did already pre-report their earnings, so that's why they rallied this past 2 weeks. On Tuesday, we have Pfizer, GM, UPS, JetBlue, MSCI. Then after the close, Microsoft, AMD, Alphabet, Starbucks. On Wednesday, we have Boeing, MasterCard, Qualcomm, MetLife. Then on Thursday, we have MO, Altria Group, Apple, Amazon, Meta, Peloton. And then on Friday, a couple of the big energy names, as well as some of these health names as well. And it's a big week of earnings, a big week of data. And where are we tracking for earnings right now? So this is the updated earnings growth for the S&P 500 year over year. Based on the earnings we've just had and expected earnings, we are now looking at negative 1.4% for the S&P 500. On the 31st of December, we were expecting earnings growth of 1.5%. What's great about this is that just last week, we were expecting negative 1.7% earnings growth. So it's really good to see that earnings have somewhat coming above expectations, except for financials and healthcare. They are really what's letting us down. But we get a lot of technology, consumer discretionary, and comm services. They are big sectors. 16.9% growth in tech, 23.2% in consumer discretionary, and 40.4% earnings growth in comm services. Now let's have a look at the charts. Now, looking at the S&P 500 chart, not much to say. We are at all-time highs, and it's really hard to say anything else besides the fact that we go higher. I mean, you look at this chart, this is bullish. This is very, very bullish. Yes, momentum does look like it's fading, but it's bullish nonetheless. I wouldn't say short at all. And I don't think anything is actually going to change with this. I do think that because we're leaving the window of weakness, Vanna and charm flows come back into the market. I think we're probably going to go to 5,000 sometime in February, by the middle of February. That's my prediction. I do think that's going to happen. And then we'll see some sell side coming to the S&P 500. Now, what levels am I looking at? Two levels right here, just below 40,700 and just above 45,75. And I do think if we trade down to this level, there'll be a ton of buy-side support. A lot of people will look at this 4,600 level as being quite attractive, especially looking at 9 to 10% earnings growth for 2024. And as time moves forward into Q2, Q3, Q4, the S&P 500 does become significantly cheaper, and 4,600 is just a great buying opportunity, all things considered. But in the near term, I do favor higher price action towards the 4,950, towards the 5,000 area before seeing any significant sell side. I do think we'll get there sometime around mid-February. But in the end, all of that will just provide a great opportunity for us to long into the end of the year. Seasonality in election years is very positive. Any pullbacks we do see, we will just use as an opportunity for higher price action looking at 5,000 and above. The only way I actually get bearish in the S&P 500 is if we have a monthly close below 4103. Now, looking at sectors, let's actually have a look at what people are buying, what people are selling. Now, prior to these 3 days, before these 3 days, the leader in the market was semiconductors, technology. Almost overnight in the last 3 days, energy, crypto, communication services, financials are the leaders in the market. So what are people doing? What's actually happening? People are selling semiconductors, software, technology, discretionary, okay? So people are selling some of these names right here. They're selling Tesla. They're selling some of their tech names. They're selling some of their semi names because it's gone up 5 to 7%. And they're buying what I would consider value, but not necessarily like deep value. Energy, yes, it's super undervalued in my opinion. Let's exclude crypto for now. And then you look at XLC, okay? Meta and Google are still trading under fair value in my personal opinion. Based on earnings growth, I mean, Meta is trading at 1.07 price to earnings growth. Financials, these guys are still trading at like a 13.5x PE. Regionals, 9x PE. So I think this is what's happening. We're sort of de-risking from growth from semis, and people are transferring some money into other options in the market that look attractively priced. And I do think we have that in XLC, especially names Verizon, AT&T, Charter Hall Group. Sure, their stocks have been beaten down, but they are looking at earnings growth over the next year, and they are still trading on like some single digits, low double digit PEs, and very low price to earnings growth. So this is why I do think we're seeing this move from these tech names all the way into comm services, financials, energy, and then crypto, just because it's been heavily sold off in the last 2 weeks. Now, looking at some potential plays for the week, guys, DR Horton. Now, let's say the Fed comes in. Jay Powell is very, very hawkish. This right here could move down into this 130 region in DR Horton. We can already see that we formed a zone right here. There was a breakout or a fake out, and then we absolutely dumped on earnings of DR Horton, and the sell side has continued. We found support right at this volume shelf right here, and there's not much volume in between this region right here. And if the Fed does come out, you're gonna say, look, we're looking at rate cuts September, October, expect DR Horton to move significantly lower. And even if they do rally into the week, you can look at this 146 level as a potential short into Wednesday if Jerome Powell is super hawkish and Yellen comes out with just a terrible bond issuance for the next quarter. Another play I'm looking at is Netflix. Now, Netflix, super strong earnings, and I do think they're going to continue higher, and I do think they're going to hit all-time highs in the near future. Now, Netflix posted great earnings, and normally what happens is this right here, this gap up you see, this was the prior earnings of Netflix. Normally they like rally up, gap up, rally, come back down to this level, and then they normally do rally as a whole. So for Netflix, you're looking at this 540, 545, 550 area for it to come back down, then a bounce up, rally to potentially get to new all-time highs by the end of the quarter. That would be a very, very great trade for Netflix. But if you've made it up until here, guys, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, hit the like button. Cheers.